Start with the Bank of England, if you would. What they're confronting as opposed to what the Federal Reserve is confronting. Where are they similar? Where are they quite different?
Well, I think they're confronting something quite similar to the Fed, but worse. Take the Fed's problem and multiply it by 1.5 to 2. And the main reason for that multiplier, if you call it that, is the energy shock, which we have been experiencing in the United States, and which is maybe over, but probably not over, is worse in Europe. And, the UK often doesn't want to think of themselves as part of Europe, but they are part of Europe. And they are getting it worse. Now, I was quite surprised to see a 13% inflation forecast coming out of the Bank of England. I don't believe the United States is in for anything like that. Look, 9% is high enough. And I was also surprised to see that kind of protracted recession projected. And I do agree with Marcus that if something like that starts really happening, you'll see fiscal stimulus in the UK just as you would in the US.
So, Alan, coming back here to the United States, one of the key issues is how credible the central bank is. We had Mohamed El-Erian, whom you know, come out earlier today on Bloomberg and say that the Bank of England actually gave the Fed a lesson in what he called honest central banking. And that's from an economist. Now, we also have some investors weighing in. Steve Radner, whom you also know, chairman and CEO of Willett Advisors, talked to me earlier for Wall Street Week, and he talked about the Fed's performance and reluctantly concluded it was not up to snuff. This is part of what he said.
The performance of the Fed over these last few years, and it's deeply troubling to me because I love the Fed. I think the Fed is one of our great institutions that has stayed out of the partisanship, that has always been data-driven, not politically driven, and I hope they still are. But their performance throughout this has been terrible. There's no other way to describe but terrible.
So, Alan, he loves the Fed, as I know you love the Fed, having served as its vice chair. Is he being overly harsh in saying it was terrible?
I think so. I mean, not good, poor, you could choose a whole variety of adjectives. And the Fed has admitted that they sort of missed the boat in the market argot. They've been behind the curve, meaning they stuck with the super low interest rates for too long. That's part of what Steve is saying, and I certainly agree with that. And look, Jay Powell agrees with that. But let's remember, for example, that the Fed was not able to forecast in advance the Russian invasion of Ukraine. First of all, it's not their business, but how could they have done that anyway? And that is not the only cause, but is a very substantial cause of the high inflation that we have today. Not only we, but also the British and the Europeans and so on. Nobody, I don't want to say nobody, there were probably some spies in the CIA or something. But nobody in the financial world really saw that coming. Jay Powell didn't see it coming, but, I don't fault him for that.
So, Alan, the question now is how do we get out of this and what is going to be required to get out of it? And one of the debates, as you know, sort of raging, if I can put it that way, in the United States is how big a hit do we have to take in employment to get inflation down as a practical matter? We have labor numbers coming out, jobs numbers tomorrow. How high do we have to drive up unemployment if we're really going to get inflation under control?
Well, I hope not too high, and that's what Jay Powell and the Fed hope. And I'll tell you what that hope is based on. If you look at the job creation over the first half of this year, when, by the way, we've had negative GDP growth, it's been almost 500,000 jobs per month on average from January through June. We've got to come down from that. But you can come down from that a long way before you even start pushing up the unemployment rate. So what I like to call the replacement rate these days, because of normal growth of the population, et cetera, is around 100,000 jobs per month. We're doing much, much more than that. We should get down to 100,000 a month quickly in order to take a little of the steam out of the economy. It's probably only as you go below that that you start ticking up the unemployment rate. And on that, which you mentioned, we're starting at 3.6%. That's below what almost any economist would estimate is the so-called natural or normal or equilibrium rate of unemployment. So, it will be painful for the people that lose their jobs, but having the unemployment rate tick up above 3.6%, as long as we're not talking about 6% or something like that, it's not an undue hardship, and you have to go through some hardship to get inflation down.
Alan, one of my questions is, how much flexibility is there for the Fed to react to jobs numbers when they come in? One of the frustrating things for some of us is the economic numbers are always backward looking. We don't know where we are right now, much less where we're going to be 30 days from now. Once the job unemployment rate starts to go up, does the Fed have enough time to adjust its monetary policy, or is there a fair amount of momentum on that in the economy?
There's potentially momentum. I wrote a Wall Street Journal piece recently worrying out loud about overshooting by the Fed. Not now, but sometime down the road. Look, the Fed is going to be raising interest rates for a while. I'm not the least bit worried where they are now about anything like an overshoot. They're certainly going to have to go higher than they are. But at some point, you talk about momentum. There's often momentum in the financial markets egging the Fed on, saying you're behind, you're behind, you're behind, inflation's too high, too high, too high. And they forget about the lags in monetary policy. So the Fed is going to have to start pulling back before a lot of people in markets think they should pull back. And they'll get some blowback from that when the time comes. As I said, the time is not yet, but it may come in the future.